As a trader, there's nothing more frustrating than identifying what seems like a perfect order block, only to watch the price move away without ever mitigating it. It's a common scenario that can leave you scratching your head, wondering what went wrong. The answer often lies in understanding a more complex and nuanced concept: order flow. In this video, we're going to explore the depth of order flow and how it can be the missing piece in your trading strategy. By the end of this video, you'll not only understand why some order blocks don't get mitigated, you'll also gain insights into how to create a more reliable trading plan by integrating order flow analysis. If you're tired of seeing your trades fall short, stay tuned. This video is designed to change that. And if you find this information valuable, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Let's dive straight into today's topic. Many traders, especially those new to the concept of order blocks, find themselves puzzled when the price fails to return to an identified order block, even when the market moves in the anticipated direction. This situation can be disheartening, especially if you've spent considerable time honing your skills in spotting these blocks. However, the reality is that order blocks are just one component of the broader market dynamic. The market is influenced by a multitude of factors, including market sentiment, macroeconomic news, institutional activity, and shifts in supply and demand. These elements collectively form what is known as order flow, and without understanding this, your trading strategy might be missing a crucial element. Order blocks, while essential, represent only a snapshot of market activity. They are zones on the chart where large volumes of orders have been executed, but these zones do not exist in isolation. They are part of a larger framework that includes the overall flow of orders in the market. Understanding this flow, continuous movement of buy and sell orders that dictate market direction, can provide you with a more comprehensive view of market behavior. In this video, we'll delve into what order flow truly is, how you can identify it on your charts, and how integrating this understanding can significantly enhance your trading strategy. So, what exactly is order flow? At its core, order flow refers to the areas in the market where there is a significant accumulation of buy or sell orders, which typically precedes a substantial price movement. These areas are crucial because they often indicate the intentions of large market participants, such as institutional traders and hedge funds, who have the power to move the market. Order flow zones are typically located where the price shows a strong reaction, either by rallying sharply or plummeting, following a period of consolidation or a retracement. Order flow can be thought of as the underlying current that guides the market. It's the collective influence of all orders, both pending and executed, that drives price action. Unlike order blocks, which are specific levels on the chart, order flow zones are broader areas where a concentration of buying or selling pressure is present. These zones often coincide with critical levels of supply and demand, where market participants are most active. By analyzing order flow, you can gain a deeper understanding of market dynamics. This allows you to predict with greater accuracy where the price is likely to move next, as well as identify key levels where the market is likely to reverse or continue its trend. For example, in a strong downtrend, a bearish order flow zone may form where the price briefly rallies before continuing to fall. Inversely, in an uptrend, a bullish order flow zone might appear where the price dips slightly before surging higher. With that said, let's take a step deeper and understand how to identify order flow on the chart. Identifying order flow on a price chart involves recognizing zones where buying or selling momentum accumulates before a significant price move. These zones can be seen as areas of consolidation, where the price moves sideways before breaking out, or as retracement zones, where the price pulls back to gather liquidity before resuming its trend. To spot these zones, you need to look for specific patterns and price behaviors. For instance, in a downtrend, you might see the price form a low, then retrace upward to gather liquidity before dropping sharply and breaking the previous structure. The zone where the price gathered liquidity before its sharp drop is what we refer to as a bearish order flow zone. This represents the last buying activity before the price moved lower, indicating a strong presence of sellers in that area. It's important to note that an order flow zone is not just a single candle pattern. It's typically made up of at least 2 candles that show a clear transition from buying to selling or vice versa. Within this broader zone, there is often an order block, which is a more specific area where a large volume of orders was executed. However, the order block itself is just a part of the larger order flow zone and should be analyzed in that context. Why some order blocks fail to mitigate? One of the most common questions traders ask is why certain order blocks fail to mitigate. The answer lies in the relationship between order blocks and the broader order flow. An order block might represent a significant level of buying or selling interest, but if it exists outside the main order flow zone, the price might not return to it. Instead, the price is more likely to respect the broader order flow zone, which reflects the overall market sentiment and the actions of large institutional players. For example, in a downtrend, the price might reverse before reaching an identified order block because it respects the broader bearish order flow zone first. This is a crucial point to understand. The order flow zone takes precedence over the order block because it represents the last significant area of buying or selling pressure for a major price movement. Let's consider another scenario. Suppose the price retraces to an inducement zone, creates a minor pullback, and then sharply moves upward, taking out the stop losses of traders who entered at the inducement zone. After this liquidity grab, price continues upward until it reaches the order flow zone, where it then reverses and resumes its original downtrend. In this case, the order flow zone represents the last buying activity before the price dropped, making it a more reliable area to trade from than the order block alone. The role of inducement areas. Inducement areas are another critical concept ties into order flow. These are zones where large institutions create liquidity traps to lure retail traders into taking positions that ultimately benefit the smart money. Recognizing these zones can help you avoid common traps and make more informed trading decisions. For example, the price might touch an upper order flow zone and then reverse without breaking the recent structure. This creates a false sense of security for traders, leading them to believe that the trend is reversing, when in fact, the price is merely creating an inducement before continuing its primary trend. These false order blocks or flows, known as inducements, can be deceptive and are often used by large financial institutions to create liquidity. Understanding inducement areas can save you from taking trades based on false signals. Being aware of these tactics allows you to stay ahead of the curve and avoid unnecessary losses. Now let's look at a bullish example. In an uptrend, when the price breaks a previous high, the zone just before this break represents the last selling pressure before the market surged upward. This is your bullish order flow zone. The price might reverse from this zone, rather than returning to an order block, leaving traders who are waiting for a mitigation frustrated. This example highlights the importance of trading with the broader order flow in mind, rather than focusing solely on order block. Let's now move on to some real-world example. On this GBP/USD 15-minute chart, we can clearly identify several order flow zones. The first example is a bearish order flow zone, where the price rallied slightly before sharply dropping and breaking the previous low. The area where this rally occurred represents the last buying activity before the price moved lower, forming our bearish order flow zone. By entering a short trade at this zone, you could have capitalized on the strong selling pressure and set a tighter stop loss, improving your risk management. Further down the chart, another bearish order flow zone is visible near a break of structure. Here, the price retraces slightly, touches the order flow zone, and continues its downtrend. This zone offers a better entry point than the order block alone and provides a higher reward to risk ratio. These setups are repeatable across various market conditions, making them a valuable addition to your trading toolkit. In conclusion, while order blocks are a valuable tool in trading, they should be considered within the broader context of order flow. Understanding order flow gives you a more comprehensive view of the market and allows you to make more informed trading decisions. By focusing on order flow zones, you can identify better entry points, improve your reward to risk ratio, and ultimately achieve more consistent profit. Moreover, Recognizing inducement areas and understanding how large institutions manipulate the market can help you avoid common traps and enhance your trading strategy. Integrating these concepts into your trading approach can make a significant difference in your overall success. Remember, successful trading is not just about identifying patterns, but understanding the underlying forces that drive the market. Order flow is one of these forces, and mastering it can take your trading to the next level. If you found this video helpful, please like, subscribe, and share it with your fellow traders. Don't forget to leave a comment below if you have any questions or topics you'd like us to cover in future videos. Thank you for watching, and happy trading.